GE is the story of the day. The shares are up sharply this morning as the company announces plans to spin off its healthcare unit, selling roughly 20 or monetizing 20% of it, and will distribute the remainder of that to shareholders. GE also saying it will exit its Baker Hughes stake. That's going to take place over the next 2 to 3 years. All of this on the first day that the Dow trades without GE as a member. It's been over 100 years as part of that index. Let's bring in Mike Santoli now, joins us here at Post 9. Of course, that's a tertiary story.
Exactly.
The
yes.
Dow part of it. You know, the key in many ways is you're going to be creating a new public entity, this healthcare company,
Sure.
that is going to be viewed along the likes of Siemens or Thermo, maybe Agilent to some extent. All these businesses share certain things with this healthcare company,
right.
Not all of them. Do you have any expectations in terms of where it should trade? I've talked to some of the people involved who believe perhaps it gets a multiple as much as 15 times EBITDA.
Yeah, I think 15 times EBITDA would be pretty generous, but also right in line with those companies you mentioned. I mean, I think arguably something like a Thermo Fisher or Agilent, you know, they're close to 20 times earnings. They're a little bit different in terms of not being as oriented toward large capital goods, right? Not imaging machines and things like that quite as much. But I do think that's the universe you're talking about. So this healthcare business had something like $3.5 billion in operating profit last year, $19 billion in sales. It's a healthy chunk of GE's total market cap right now. And I think one reason you're seeing relief in the stock is that, you know, investors just want to be able to have some basis to value all the pieces. And now this is going to give that to you. Of course, GE Baker Hughes is another way to do it, 2-3 year exit. And then the rest of it is, you know, it's simplified, and then you're betting on, or not betting on, a turnaround, depending on how you view it.
Yeah, you know, and speaking of some of the people who crafted this deal, it's their belief that the healthcare company's worth about $5 a share, let's call it. Aviation could be worth as much as $11 to $12 a share. Baker Hughes, well, that's an easy calculation because you can just look at the market. Let's call it $2.50 a share, and then power and turnaround. And so they obviously get to a number that is quite a bit higher than the current stock price, even with it up. But you still got GE Capital that you're dealing with. You've still got a lot of pension liabilities, concern about that balance.
Exactly. To me, it's about how you allocate the liabilities and how you view the liabilities in terms of being this consistent overhang on parts of the business. So they know what healthcare is going to shoulder in terms of debt, right? So, I mean, I think a lot of it is a matter of getting clarity on all these things. Now, that exercise you just went through there, David, doesn't get you to 30. No. Right? So that's the amazing part here is that 2 years ago, that's where kind of you traded. So there's a huge gulf between where we can kind of hang our hat on some valuations and where people mentally, I think, anchored kind of the stock price for
a lot of them former employees of the company who've held on to their stock, I can tell you.
We're just going to bring up the cash situation because I remember in the interview with you last time Flannery talked to us, he said he called the cash flow situation horrible, which was interesting to hear from a CEO. I mean, what does this do to improve it, or is it hard to find a clear picture
It's
yet?
a good question because, well, healthcare, I think, is a cleaner business when it comes to that, right? I mean, I think in GE's own materials, it says that it's basically all free cash flow in terms of operating profit. I mean, so that's the good stuff. And I think the question of, you know, power business and exactly how much cash you can generate and run it in a way that does maximize cash, I think that's going to be a persistent question.
Yeah, and the balance sheet is a sort of a key focus for so many investors. We should mention they're targeting net debt to EBITDA to be less than 2.5 times by 2020. That's a reduction of over more than one turn of leverage over the next year and a half or so, and a reduction overall of about $25 billion in net debt and pension liability. So there is a lot going on and a lot for investors to sort of sort through.
Interesting that deleveraging is becoming a bit of a theme here, whether it's at AT&T, you know, granted in the wake of a big deal, but now here too.
Yeah. Well, yeah, I mean, GE added a lot of debt for all the deals that ML did, for the buying back of stock that they did even as recently as 2016 and 2017, and that is dangerous.
And big companies did in general, right? I mean, the markets were begging big companies to borrow cheaply, and they have done so.
And activist investors like Trian, if you look back at their original deck, when they came out with they wanted them to borrow an additional $20 billion.
Sure. And the composition of the debt, right? So GE overly relying on short-term commercial paper. They're going to try to term that. So it's a simpler, maybe more stable business financially. You just don't exactly know how much the market's going to value it at.
Thanks, Mike.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.